What started off as a quiet day in the stock market turned into quite the eventful day as more news stories started to unfold. We had Johnson & Johnson that was kind of leading the Dow early on after a court case involving them and the opioid crisis. We then heard news of Philip Morris potentially wanting to buy Altria. We then had the tens and twos yield curve invert. We then had a lot of people going back and forth on whether China and the United States had a conciliatory phone call or not. So a lot of different things going around. What I can say is that we did close lower across the board, so we retain our bearish posture on all four market indices here in the United States. However, with the Russell 2000 being down as much as it was today, it actually did form what's known as an oversold cluster signal. So we'll see if this can perhaps be the start of a potential bottom. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's August 27th, 2019. For those of you that are new, welcome. Remember, click on subscribe while you're over at YouTube. Also check out our description area where you can sign up for our email distribution list. We're also heavy users of Twitter. Feel free to follow me at Brandon Van Zee, and we appreciate those of you that click like and retweet on our Market Outlook related posts. Lastly, feel free to join us over on Facebook at the group web address embedded in the logo in front of you. All right, let's go ahead and dive into our charts now. As you can see, I've got chart 4B pulled up here in front of us, and this will show us the four major U.S. equity indices. As I mentioned in the intro, we do have a bearish posture. Now, that's not anything new. We've had a bearish posture for the last few days, but we retained that today due to the fact that we were down pretty much across the board. Now, we were down to various degrees. You will see that the S&P 500 actually fared the best. It was only down 0.32% today, whereas the Russell 2000 fared the worst. That's the one in the lower right-hand corner here. It was down over 1% today, 1.35% to be precise, and we closed nearly at the lows of the session. Now, in doing so, you'll notice this little green dot that's showing up down below here. In fact, let me right-click and go to maximize sell so you guys can see this a little bit better. Note that there's a green dot right here and a green dot right here. What that is signifying is that we have what's known as an oversold cluster signal. You can see that occurs when we have the green, the red, and the blue line all in the lower reversal zone below the number 20, all at the same time. And oftentimes that can be a sign that we're getting closer to some sort of at least a shorter term bottom. Now, you'll notice that the last time we had an oversold cluster signal was back here on this particular candle for the Russell 2000, and that was on August 15th, just earlier this month. And as you can see, again, we had those green dots signifying that we had some oversold conditions there. And what that led to was an immediate two-day rally that was actually fairly strong. Now, whether that happens again here or not is anybody's guess. We do have a bearish engulfing candle here that we're dealing with as of today as well. And also, I should point out that back here about 3 months ago, and this would have been back on June 30th, actually it's May 30th, and May 31st, we also had those oversold cluster signals on the Russell 2000, which led to a much more substantial rise after that. So, obviously, we can't guarantee that the past will unfold perfectly into the future, but at least we have some recognition of the fact that when we've had these oversold cluster signals in the past, they have been interesting times to be speculative to the opposite side. In this particular case, reverting to the mean to the upside. So for those of you brave enough to take some bullish trades, perhaps that can help give you that resolve there. Now back on over to our four grid setup here, just to to take it home, so to speak. We do have the Dow Jones with the bearish posture right now, falling below that moving average. Same thing goes for the NASDAQ down below here as well. So strongly bearish postures across the board. And like I've kind of been mentioning in the last several weeks, at least the last 3 weeks, we've had some times where the posture reverts back to bullish. But as I told you then, and I'll continue to tell you now, I'm not overly convinced that we should be wildly bullish despite what the posture is telling us in those fleeting opportunities. And the reason for that is price was below a falling moving average. So if we do get some sort of a bounce higher in these indices and we get a bullish posture from the market forecast perspective again. If we're still below a falling moving average, I'll be hesitant. On the other hand, if this turns into kind of a triple bottom type of a situation in the markets and we rally higher, we can consistently stay above that 30-day moving average, and we have a bullish posture, at that point I'd probably feel a little bit more comfortable. But of course, we're in the fall right now. We're in a very precarious time from a geopolitical perspective, so there's a lot more chaos taking place here, and you can't really trust this market too much further than you can throw it at this current time. So always helps to stay nimble whenever possible in a situation like this where we have kind of more chop and slop to the sideways. Let's go ahead and take a look at our next chart setup now. This one will be our 3 green arrows chart setup. This is chart 4C. And as you can see here, in 2 of the cases, we actually have 3 red arrows right now. And those 2 cases are the bottom 2 charts, the NASDAQ Composite and the Russell 2000. And as you can see here, the background color of the chart being pink right there and being pink right there will let me know quickly from a visual perspective that we do have 3 red arrows. And you can then verify with your own eyes that that is the case as you look at the indicators themselves. For instance, here on the Russell 2000, we've got that red arrow up there on the moving average. We've got that red arrow down there on the MACD histogram. And we've got that phantom red arrow popping in there on the stochastics. And other thing I should have mentioned a moment ago, which I'll mention now, is not only was it an ugly close to the day for the Russell 2000, but this was actually a 3-month low that we hit on the Russell 2000 today as well. Notice that that low label is pointing directly at today's candle. That's of course not the case with the other indices. We're still quite a long ways above our 3-month low levels on, let's say, the S&P 500. You'll notice that we're currently trading at about 28.69. The low level there was back in June at 27.28. So it does make the Russell 2000 situation a little bit more precarious there, considering we are starting to break some of those horizontal support levels there. So we'll have to see if that bullish cluster, or that oversold cluster, I should say, can kind of fight off the natural tendency of traders right now to be pushing this lower after a broken support level. Let's go ahead and see what we've got coming in here next, and that is going to be our 1040 crossover method. As you can see, the only chart that does have a negative crossover at this current time is the Russell 2000. We know that quickly with that background color being nice and pink there on this chart 4D in this particular case. Remember, these are weekly candles on these charts, and each one of these charts are 3 years in length, so it kind of gives us a longer term view as to what has happened to the markets over the last 3 years. And largely it's still been a bullish decision to be involved in the stock market for the last 3 years. Obviously, the last couple of weeks have been a little bit uglier, depending upon what areas you're nibbling in. But for all intents and purposes, the stock market has still created wealth over the last 3 years. Now, obviously, we are in quite the expansion period here. It's been, over 10 years at this point since we've had a prolonged bear market. And so it is worth noting that that can happen at any time. Remember that one of the things I mentioned in the intro is that we did have an inverted yield curve, and David had a great comment on Twitter today regarding how we compare this yield curve inversion to where we were in 2007. That's really the wrong way to be looking at it, because one of them was going up, rates were going up, and one of them was when rates were going down. Really, you should be comparing it to much earlier than that. But a lot of times the media likes to fixate themselves on the 2007 year because they know it's clickbait, and they know that they will start kind of giving the impression that a stock market plunge is just around the corner like we saw in 2008. That doesn't necessarily have to be the case. Even with prior yield curve inversions, in fact, for this conversation, let's just briefly come on over here to chart 4J. This is our chart that can show you the yield curve inversions a little bit better. If you want to look at the 10s and the 2s, it's this bottom line down below here. Up above here in this upper price plot, you'll see a lot more of those different series, whether you're looking at the 1 year or the 5 year or the 20 year or the 30 year or what have you. But you can kind of see even from that perspective, they kind of all get bunched up together like they did back there. They get bunched up together like they did over here and even over here. Now, if you just want to break it down into just the the 2-year versus the 10-year, you come down here and you look at this and you'll see, yeah, you did have an inverted yield curve that took place back here right after the dot-com kind of era, which is commonly referred to as the dot-com bubble. And then we also had inverted yield curves a couple of different times right here as well. And so there is reason that folks might be concerned that a inverted yield curve could eventually lead to some sort of a chaotic market moment. But oftentimes what we've seen historically is that it often takes up to a year before we actually see that, if it happens. It is true that the vast majority of prior recessions or economic tailspins have occurred after an inverted yield curve, but remember, not every single inverted yield curve leads to one. So those are two different things. It is a common occurrence of the recessions that ultimately happen, but not 100% of inverted yield curves do lead to a future recession. So as always, we do our best to try to look at what the market is telling us right here, right now. Now I've gone on over here to the chart 4E, which will be our first set of 12 grids here on the intermarket analysis. And so as we look at this, one thing to point out is the VIX. It's up 5% today. Notice that it is trading above 20. That has typically been an area of kind of resistance in the past, at least. You know, we have had eras of heightened volatility in prior years where 20 was not a big deal, but in recent years 20 has kind of become an area where a lot of people feel like we have elevated volatility levels. We'll actually kind of try to take advantage of that concept in our trade application example a little bit later on in the video. But obviously when the market struggles, the VIX has a tendency to go up, and that is what we did see here today. Now note that the 10-year Treasury yield did fall yet again today. These are fresh lows here, at least fresh lows from a multi-month perspective. And as you can see, we are currently residing at the close at 1.49%. When I was looking at the 2-year earlier in the session, it was at about 1.52%. So in other words, that's your inverted yield curve. Now remember, a lot of times when you're looking back historically, you might be looking at weekly candles or monthly candles. And so since we're kind of in the middle of the week right now, there are no guarantees that there'll be an inverted yield curve at the end of this week or at the end of this month. But at least on an intraday basis here and even a day-to-day basis, we're seeing more instances of that possibility taking place. So as we do find interest rates falling or continuing to fall, of course, the opposite is also true. Bonds continue to go up. Down below here, you'll see TLT, which represents the U.S. government long bond. And as you can see, it was a beautiful day for that particular instrument. We were up 1.5% in the long bond market. In addition to that, here I am with my broken record again. There's your foreign bonds. A beautiful looking chart. BNDX, one of the most consistent charts I've ever seen in a 3-month period. I mean, that thing just does not want to fall out of its uptrend. Even when it goes down, it usually only goes down for a couple of days and then right back to where it came from. So that has been a wildly consistent trend that we've seen there. We've also seen gold become a star performer in this current marketplace. I mean, if you look at a lot of the gold charts out there, they are looking superb. Let me right click on GLD right here and maximize this so you can see it a little bit better. But that is a beautiful looking uptrend over the last 3 months. Oftentimes market participants go to gold as kind of a bastion of safety when there is chaos from a geopolitical perspective, and that's kind of the role that it's taking right now. And as you can see, we're hitting new 3-month highs just as of today. Very strong performance out of GLD, up nearly 1%. But it goes beyond that. Most of you are aware that GLD itself just represents the price of gold bullion, the commodity itself. Those of you that have a little bit more of a tolerance for risk might also be interested in looking at some of the gold mining stocks. Those companies that get the equipment out and dig in the ground and pull out the bullion. If they can do that successfully, they can make some excellent profit margins if gold prices are high. And so if you wanted to take a look at that as a whole, you could look at GDX. This is the gold miners ETF, and this is focused on the senior gold miners out there, the bigger companies. And as you can see, we're hitting multi-month highs here today on GDX, a beautiful bounce off the moving average here a week and a half ago, just like we had back here at the beginning of August. So this thing is shaping up very, very nicely here. The GDXJ is going to be your junior gold miners. You're stalling out a little bit more there, so it does seem like the seniors are a little bit better than the juniors right now, but even this was a nice looking bounce here. The key difference is we're not up and through these high levels that we saw at the beginning of August the way that we were with the senior gold mining companies. So some of those senior gold mining companies that you might be interested in, GOLD is one. This is Barrick Gold. They recently had a merger. Their old ticker symbol was ABX, and so they've kind of taken over the new ticker symbol of GOLD, which is quite apropos. And as you can see, Barrick Gold really taking off to the upside. A beautiful looking candle here. We are up nearly 3% on that one today. Newmont Mining is another nice looking chart here as we break up and through this prior resistance area right here. You could take a look at Royal Gold, RGLD. That's another excellent looking chart there, up 2.5% today to new multi-month highs. KL is one that I brought up many times in these market outlook presentations in the past. It continues to work as well. This thing landed nearly on $50 even here. It was up 4.84% today to a new, that's going to be an all-time high that we're looking at there for that particular one. So those are some of those names that continue to work very, very nicely out there for those of you that are kind of willing to take on and assume a little bit more of that individual corporate risk in the gold market as opposed to just simply the bullion itself. So those are some of the key movers right there in the intermarket basis. Let's go ahead and take a look at our next set of 12 grids now, and this will be our foreign stock markets 12 grid. As you can see here, we've got a little bit of a mixed bag, but I would say that the tilt is negative right now. Even the ones that have a green background color, which signifies a bullish intermediate posture according to the market forecast technical indicator, even those ones that have that, I would say the charts are not all that appetizing. They don't look like those gold charts I just showed you. These are charts in the case of Mexico, Canada, Japan, and Germany that are kind of holding the line. So, you know, good for them. They're not plunging. They're not breaking support levels. But at the same time, they all reside below a falling moving average. So it's kind of the similar story that I mentioned to you regarding my thoughts on the S&P 500. You got to prove it to me. If you're gonna break out to the upside, eventually you got to get up and over that moving average. Until then, I'm going to kind of approach those types of situations a bit more cautiously than I would otherwise. Some of those other areas are looking pretty ugly. You can see Israel kind of fell off of a map here today. It was down 1.55% and closed at the lows of the session. South Africa is closing near multi-month lows right there. Brazil is so bad it could be good. In other words, Brazil has fallen so far here that we might actually have a little glimmer of hope in the oversold cluster signal. So kind of the same conversation I had with you regarding the Russell 2000. With such a big sell-off here, it is possible that we get a little bit of a short-term burst to the upside to kind of work off that condition. We'll see if that can take us anywhere further than just a bear flag, however. And so that's always a possibility right there. Let's go ahead and take a look now at our next chart setup, and this will be our U.S. sectors 12 grid. And as you can see here, it's a pretty ugly picture in the United States as well. Where we do have strength is in the bottom rung here, which I kind of have set aside for our more defensive and interest rate sensitive areas. And so not a big surprise there. Remember, when the market is chaotic and the market is choppy and the market is in a foul mood, oftentimes if there is any strength out there, money starts rotating from the more cyclical areas of the market into the more defensive areas of the market. And that is what we've kind of seen here over recent history. You can see that the staples, the utilities, and the real estate stocks are the ones that can claim a bullish market forecast posture. You'll also note that those are the only three charts on the board in front of us that have stock prices, or in this case ETF prices, above rising 30-day moving averages. Notice that the moving average is green there, and green there. However, all the other charts on the board all have red moving averages and also red background colors. And so it's nice to see some stability there with the defensive names. But remember, the defensive names are a relative afterthought in the grand scheme of things for the stock market. The staples, the utility, and the real estate sectors have very small market caps compared to things like the financials and technology and industrials. And so it's great to see some strength there, but I wouldn't get excited about it when we see the leadership consist of the defensive areas, because we're going to need some of those other more cyclical areas to start stabilizing and start bouncing higher before the entire market can do that. Now, speaking of sectors, you can see over here, as I switch over to the internet briefly, I do have my sector selector posted as of last Friday night, and not a surprise. Those three sectors that I just mentioned a moment ago from a market forecast perspective are also considered relatively strong from my ranking system here on the sector selector. We had real estate come in number 1 for the 3rd straight week. We had utilities come in number 2 for the 4th straight week, and we had staples come in number 3 for the 2nd straight week. So, week over week, none of those actually changed rankings, whereas we had a lot more changes down below here. Energy, of course, pulled in dead last yet again. Also, since we're over here on the internet, I always like to say thank you to those of you that click like on these videos. We certainly appreciate that. We had the exact magic number of 100 of you clicking like for me the last time I did the video on Thursday, so that makes me a happy camper. Anytime we're at 100 or above, I'm happy about that. Anytime we're below 100, then I start questioning whether we need to do these videos every single day or whether we can just get away with doing them once a week or something along those lines. So if you want to support these videos, if you want us to give us your opinion on whether we should continue them as often as we have, then we ask one simple thing out of you. It takes less than 5 seconds. All you have to do is click like. And we make it nice and convenient by putting the link directly below where you might be watching the video on our website, so you can do it while you're watching the video. We also, of course, send out the links for our Twitter feed via email. We have it embedded in the description area of YouTube itself for those of you that watch the video over there. And then, of course, you should know by now that David and I also just pin the market outlook related post to the top of our Twitter timeline for those of you that want to go directly to twitter.com. So lots of ways for you to easily let us know your appreciation. And for those of you that do that consistently every single day, we really appreciate you. And we'll hope to continue to work hard on your behalf. All right, so with that out of the way, let's go ahead and talk about our trade application example here for tonight. I'm going to come on over here to, let's just do a chart for A in this particular case, just a regular market forecast 1 grid. And I mentioned before that the VIX is relatively high right now, right around 20. And that's a level where perhaps it starts making a little bit more sense to look at selling some premium as opposed to when the VIX is extremely low and you're not getting much credit out of that. So what I wanted to do is look at a mega cap company here today. In fact, it's the world's largest publicly traded company, and that is Microsoft. Now, as you can see, Microsoft has done a fairly good job not, falling out of bed. Some of those other bigger technology companies have fallen a little bit more violently. As a matter of fact, I noticed earlier today our bear call spread on Netflix that we had done in one of these sessions, NFLX, had gotten filled on the maintenance portion. In other words, I was able to lock in 80% of our maximum gain today, and so that tells me Netflix has likely been falling recently, and that has been the case. So you look at a chart like Netflix, which used to be the really exciting up-and-coming growth type of a stock, and then you kind of compare that to Microsoft. Microsoft has clearly been doing a better job of holding the line. Now, obviously, they have a lot more cash flow and profits and things like that than Netflix, so that's part of the story. But however you slice it, whether you think it's Netflix falling based off of their competition they have coming out from Disney, or whether you just think that the market doesn't like growth stocks that don't have a lot of profitability right now. However you're looking at it, the fact of the matter is, Microsoft has been in a sideways range for much of the last several weeks. One way that you can try to take advantage of that is by selling what's known as iron condors. An iron condor allows you to basically sell both sides, both the upside and the downside of a particular stock, if you believe it will channel sideways into the future. Now that's just as tricky as anything else, but a lot of times people want to think in their head, okay, well, if we have a recent history of channeling sideways, then my assumption going forward is a continuation of a channeling sideways. Now, obviously, the stock market will prove us wrong plenty of times when we think that way, but at least it's one approach to consider. So with Microsoft actually closing higher today, it showed a little bit of relative outperformance. On the other hand, notice that we have a red moving average and a red background color of the chart. So we kind of have opposing thoughts there, and that makes sense. Anytime we have a sideways channeling stock like Microsoft here, oftentimes you have opposing schools of thoughts with the various indicators that you might be looking at. Some of them are going to show you bullish, some of them are going to show you bearish. That indecision is what is creating a floor and a ceiling and approximately the same areas of this stock repeatedly in the recent history. So in order to set up an iron condor where we want the stock to continue to go sideways and we want to benefit from the decay of time, we'll come on over here to the trade tab, and I'll show you what I've got loaded up down below here. You can kind of see my order I've got loaded up in order to save a bit of time during the presentation here. And what I've selected is the September monthly contracts. These are the ones with 24 days left until expiration. Microsoft does not trade through an earnings announcement through that time period, so it'll be a nice and easy one for us to get away with. Now remember, we won't always be able to get effective iron condors done with only 24 days left until expiration, but because we're in a higher volatility period right now, I did find this one to be reasonably successful for our purposes here. Its implied volatility on Microsoft right now is at about 27%. Now notice down below what I've selected in terms of strikes. The sold strike on the call side of the equation will be 144. Now note we're close to trading at about 136 right now. So 144 is the level we do not want Microsoft to go above on the upside in the next 24 days. I have then bought a 146 call against that. So we're selling the 144, we're buying the 146. So all by itself, that would be a bear call spread. But when you then add in a bull put spread like I have down below, that's what creates the iron condor. Now on the put side of the equation, I'm selling the 127 strike. So in that case, I'm saying I don't want this $136 stock to come down and fall below 127. We then bought the 125 as part of that. Now the reason we're buying the 146 call and the 125 put is because it allows us to be a little bit more comfortable with our trade in case we are just flat out wrong. If the stock market crashes tomorrow and some unforeseen event happens, there's a nuclear bomb somewhere or something along those lines, and the stock market crashes 10%, in one single day, then Microsoft is likely going to get, it's going to go into meltdown mode in that case. And so by buying something like the 125 put, it basically is our built-in hedge because it basically says, yes, we now have a contract that allows us to sell 100 shares of Microsoft at $125, even if its price melted down to, let's say, $100 even. And the flip side can be true as well. Now, I don't anticipate anybody coming out and making an offer to buy Microsoft, but then again, I probably wouldn't have said that about a $100 billion company like Altria before today either. So I suppose anything is possible. So remember, a gap up could also occur. And if the stock were to gap up way above 146, that's why we own the 146 call, because that call gives us the right to buy 100 shares of stock at that price. So what it does is it limits our risk by having some bought strikes combined with our sold strikes. The net effect of all of that is that we have a 53-cent credit in the end. Now, if you're wondering what sort of a return on risk that is, you can just simply click confirm and send. And then you can pull up a calculator and you take the max profit, in this case $53, divide it by the max loss, in this case 147. Obviously, this is just for one contract. Feel free to do as many contracts as your position sizing rules suggest. But in this case, it doesn't really matter if you're doing one contract or 100 contracts. The return on risk is going to be the same either way. And in this case, it's 36% return on risk. So nice and easily above the 30% that we oftentimes will shoot for these credit spread types of trades here. Now, you'll also notice here that the break-even price on this trade is 126.47 on the downside, right there, and then 144.53 on the upside right there. So if I were to click out of this for just a second, In fact, let me do this. I'm gonna fire this off so that way I don't forget. So I'm gonna send this in. We'll see if we can get filled on that in the morning. But before we get there and shut down the video, I also do want to show you where our break-even prices would be on the chart itself. So let me get out a drawing tool and let's just do this price level right here. There we go. And let me draw one line kind of up in this vicinity. Once I've drawn it, I can right click, go to edit properties, and here I'm going to type in 144.53, which was our break even on the top side. That's right up at that level. And then I'm going to draw another line kind of down below here. Right click on it after I click it into place, click edit properties, and in this case I'm going to go to 126.47. Click OK, and that range right there is what we're dealing with. As long as you think that Microsoft will stay somewhere between that upper dotted blue line and that lower dotted blue line for the next 24, 25 days until the September options expiration, then this could be an effective trade for you to consummate. So with that, let's go ahead and wrap things up. All right, thank you for joining me here yet again tonight. David should be back with you tomorrow. And remember, he also does the live market outlook video kind of recap trade ideas with a half an hour before the market closes on his sessions. He does that on Monday, Wednesday, Friday. I'm not to that point yet. He's kind of working out some of the technology there. Eventually, I might get up on that as well, maybe a month or two down the line. Also, quick programming note, a week from today, I'll be on vacation, so there will be no market outlook video on Tuesday of next week. I'll try to remind you of that again this Thursday since I'll be with you at that particular time. But as of today, we do have bearish postures across the board still, and we do want to be mindful of the fact that we also have an oversold cluster signal on the Russell 2000 small cap index. So with that, I wish you all the best of success with your trades and your investments. If you got any value out of tonight's video, make sure you go over to Twitter and click like for us. We really appreciate that. Have a great night, everybody. Take care. Bye-bye.